mean,
Yeah.
I met a few of them, like Jamie Dimon, the CEO
Oh,
of JP Morgan Chase. I took
welcome, guys, to the part two of our interview with Michelle Markey. I'm really humbled that she agreed to do this part two because our conversation last time was really great, and it got me started in this model that I discovered that I like a lot, to chat with people that know so much more than me in different areas. And I hope you guys learn to something or another. So, do you have anything to add, Michelle?
Well, thanks for talking with me today, David. And I always enjoy talking with you. And I admire your enthusiasm and passion for learning about investing. And I think you're on the right track. And you're probably going to become a millionaire a lot sooner than a lot of people you know. So that you're going to do great.
Oh, that's that's great to hear. I don't know if I'll become a millionaire faster than other people, but at least I'll be happier.
It's good.
So that's nice. Michelle, I would like to start talking about like the interview you gave with your amazing friend at the Millennial Investing podcast. I found it like very interesting, and I was wondering like how did you got the opportunity to give this interview?
Well, I'd been in touch with the founder of the Investors Podcast, Stig
Ah,
Brodersen, and
nice.
Sina and I also know him because Sina's from Denmark and Stig is also from Denmark, so they also knew each other. So just by staying in touch, they suggested, "Oh, would like to do this interview with our millennial investing?" So that's how it basically happened. And then we got to meet Rebecca Hotsko, and she's very intelligent and very knowledgeable about investing. And she's such a hard worker. And I also admire her greatly. And it was just a pleasure and honor to be able to interview with them.
Well, that's amazing. And sorry, but I forgot to introduce what's the investing podcast. So, would you like to give any like brief explanation on what is it about and why it's so good? Yeah.
Well, the Investors Podcast Network was one of the founding podcasts of the We Study Billionaires podcast. And I listened to that many years ago, and it's been a really great learning tool. Like, if you listen to that and all the interviews they do with a lot of famous investors, when Stig Brodersen and Preston Pish would interview a lot of people and explore investing topics, it was very educational for me as well. So they've since branched off into more podcasts, including Millennial Investing and a few others. Like also William Green has a podcast, which we both really admire William Green, and he's such a nice person. And he wrote the book Richer, Wiser, Happier, and he's also on that network. So it's great to be able to, just be part of that community and contribute to investing knowledge.
Oh, that's great. And I was wondering like the what's the name of the investor that was interviewing you, you both you?
Well, the podcast host, her name is
Yeah.
Rebecca Hotsko.
Oh, nice. And what's like her background?
I think she's been formally educated in, say, finance or economics, and she's from Canada. So I think she's learning more and more herself. I think she's a, I'm not sure if she does investing professionally, but I think she's more doing the podcasting and interviewing people.
Yeah, she was very good at making questions, and you were very good at answering them. So that's very good. And I'll make sure to leave the link in the description for the curious ones that want to check it out. I'm sure it will add a ton of value. And it was very interesting because I um, I listened you introduce some books that I've never heard of, and I'm curious to check them out about like different ways to value companies, especially tech stocks. Could you expand a little bit more on that, and what has been your journey in terms like of investing philosophy of valuation, because there's really a lot of stuff about the valuation topic, and it can be a little bit overwhelming for the for people that are starting. And as you said, like it's not the intelligent investor or those classic books are not for everyone, because the kind of the way they put things might not be the most updated. So what's has been your journey so far in that field?
Well, for example, the one book I mentioned during that call was called Where the Money Is by Adam Cecil. And he is a professional investor, I think, based out of New York City. And he explained how you can still apply a lot of Warren Buffett principles to even tech companies, even though we know Warren Buffett historically stayed away from a lot of tech companies until more recently when Berkshire invested in Apple and even things like Taiwan Semiconductor. And so to try to understand some of these technology-based companies, we have to try to look at the financial figures in a little bit of a different way than maybe just straight off the page. So if you bring up, say, the income statement or balance sheet or cash flow statement, you might see, just black and white, some of the numbers, but then some of them are okay the way they are. And some of them you have to tweak a little bit to get a better understanding of what's happening, because there's a lot of research and development that these companies are
Yep.
doing. So that gets considered to be an expense. But if you just see it as an expense, it's not the same like buying, a hamburger and then you eat it and then it's gone forever. If you are investing, it's like buying a book and learning from the book, and then that knowledge, even though
Compounds.
you spend $20 and it's an expense, so you don't get that money back directly, but you're investing it in a different way. So maybe you will get money back in the future in a better way than just a normal expense. So in that way, the research and development that a lot of companies do, it's part of why they might not have as much profits, right? On the surface, it looks like, oh, maybe they don't really make money, but really they're using the profits and putting it back into the business so they can make more money in the future. So when
Right.
they do that, you have to think about adjusting some figures. Like, for example, I think one of them was operating margin.
Mm-hmm.
And so let's say the final operating margin that's presented in the figures is, say, 10%. I don't know if that's good or bad. It's just an example. But let's say 10%. But then when you look at some of the competitors, like let's say you compare Google with Facebook, and they're both in advertising. So if you compare those, Facebook, let's say, might have an operating margin of 40%. So what something like Adam Cecil suggested is, if you feel like they're similar, that they are, that Google's operating margin is actually closer because they should be doing just as well at the advertising business as Facebook is. So then you adjust up, say, Google's operating margin to similar to what Facebook might be. It may be 40%, maybe not, but let's say that's like a rough estimate. So then you might adjust certain calculations based on making some of these figures a little bit similar, like more comparable, because instead of just saying, oh, all of that was an expense, all the efforts that the company is working on, you give them more credit for it and adjust up. So when you do that, you can reach an explanation for justifying a higher, let's say, price to earnings ratio. Like a higher PE ratio can then be explained and say, okay, it makes sense that it's not trading at 10 PE, but is at 20 PE, and it's a good price here at that. Let's say that's just hypothetical. I'm not saying Google is a buying company. Like you shouldn't
Yeah.
necessarily listen to any advice here. I'm not saying to buy Google or Facebook. Like, these are just educational examples. So
Yeah.
everything I said is, I just made up some numbers. These might
Yeah.
not
Yeah. Sure.
be final
Uh,
numbers of reality.
Yeah, that's a good advice for the listeners. Like, even in the last part, we talked a little bit about Starbucks and you mentioned some numbers, but remember, everyone can be wrong, even Charlie Munger or Warren Buffett, and like mortals like us might be wrong like 99% of the time. Plus, these are just like examples. So yeah, that's good that you mentioned that. And there's a couple of ways we could expand on this, but um, one of the things that got me curious in these last few weeks was that I saw a report that suggested that only like 5% or of the professional money managers outperform like the market in a given year,
Mhm.
and that number goes close to zero like if you expand the time period into 5 years or something like that. I'm not sure, but how do you like make sure that the advice you are receiving, let's say from these books, because we know that books like The Intelligent Investor and these classic books might be outdated, but at least they time has proven that there's some substance to what they are telling us. So I'm sure you did your research on these authors, and but how's your approach to that? How do you know like this is actually some valuable kind of metric or way to evaluate these businesses?
Well, a lot of it you find out after you've done it. So let's say even if I do valuation calculations, the only way to really know is when you actually invest. So
Right.
it will be trial and error when you put real money, your own hard-earned money, and you invest it in a stock, and then you will see over time, especially if you hold it for longer periods of time, to see if you were right or wrong. And
Hmm.
it's hard to know if you were right or wrong in even the first year or the first 5 years. You might need to hold something for a really long time, like 10 years or more, to see if you were right. But sometimes, if it's a mistake, you don't want to hold it that long in case you realize, oh, I made a mistake. This company is not going to perform the way I expected, and then maybe you might sell sooner. Like when Charlie Munger said that he realized Alibaba was a mistake, it makes me
Yeah.
wonder: did Daily Journal sell, or are they still holding on to it? We won't know yet. We'll maybe find out
Yeah.
if it's still on his equity filings, the 13F
Yeah.
form, if it's on there by, I think, early April. So maybe soon enough, we'll see if Daily Journal wants to hold on to this mistake, or if they're, like if they're going to say, okay, it's not worth it, we have to sell. So it depends how, even as great of an investor, like you said, as Charlie Munger is, he said it was one of his biggest mistakes. And I was surprised because, he's so wise. Like, how could he make a mistake? He knows better than everybody, right? So it's a little
Yeah.
bit like surprising that it'll be interesting to see what they decide. So really, it's hard to know. You have to use judgment, and the only way you get judgment, like better judgment, is if you made mistakes and then you learn from the mistakes. And that's what Charlie would say: is you get better judgment by just experiencing things, and you try to make the right decision, but sometimes it's not the right. It may not have worked out, and that's okay. It's okay if it doesn't always work out, but as long as we learn from it, that's the most important lesson, is just to keep trying to learn and keep trying to do better. And that's what also separates a lot of people. Like, the people who are successful from the people who are not successful are the people who want to improve, who want to get better. And so if you're curious and you keep pushing yourself forward and you don't give up, you will eventually learn and you will eventually succeed. So that's important, because a lot of people, they fail not because they weren't smart enough or they couldn't do it, but behaviorally they just give up, or they're stubborn, or they resist change, and that part is what can be dangerous.
Right. That's so interesting because before we started the interview, I told you about this podcast I listened of the founders podcast, and the host had dinner with Charlie Munger. And
Mhm.
one of the lessons I took from the podcast was a life worth living is the one full of well dealt mistakes. So basically, it's the life that you have plenty of mistakes, but you actually learn to deal with them and
Mhm.
take something. So that kind of goes in line with what you said. A follow-up question I have is like, do you do any background or track record research on this? For example, Adam Cecil, you mentioned,
Well,
like,
I just saw his bio in his book. Like I just saw that part, and I added him on LinkedIn. So he's very
mm,
friendly to talk with. So yeah,
okay,
it would be good to, like a lot of investors that are like in this area, like that, like Warren Buffett, they're very friendly to talk with. So I know we talked about some of the friendly ones, like Guy Spear
yeah,
and also William Green, very friendly people. So yeah, like you can just learn about a lot of people, and there's other great investors to learn from, like Matthew Peterson, and also I wanted to mention this other investor that he doesn't have an investment fund anymore, but he just trying to find it real quick. I was
yeah,
looking
for sure.
real recently. It was Nicholas Sleep. He
Ah, Nick Sleep, yeah,
Yeah, he's
from
also
Nomad.
yeah, he's also good to learn from. So there's so many, like I it's amazing how much, if you reach out to some of these people, they're very friendly and nice. If you have questions and you just want to learn a little bit more, they usually answer you. So it's great like that.
Oh, that's amazing because that's like one of the my favorite things to do. And actually, all the people I meet like from the investing world is from reaching out and like uh people usually I think when you find yourself in a positive culture, people just like feel more incentivized to teach others and to be nice to others, I think.
Yeah.
Um, so one question I have now that you mentioned this is, what are some cool interactions you had with either mentors or investors? Is there anything it pops up to your mind, like some interesting thing you would like to share with us?
Well, one of the cool things is if you ever get to meet some really good investors in person, and trying to learn from them and their techniques of how to really get an edge in investing. And one of those people is Laura Rittenhouse, and she wrote books like Investing Between the Lines, and that one is a good book. Like it taught me how to read the letters written by the CEOs. So whenever
Hmm.
companies release their annual reports, sometimes they have letters, or in the case of Netflix, they also have quarterly letters, which is a little uncommon.
Hmm.
So by learning about how to read these letters. So there are certain ways that Laura Rittenhouse points out, and I met her in person before, and she really explained to me more about how, by reading these letters very carefully and discerning whether someone is being honest, like being very candid is important, like this condition of having candor. Like
Hmm.
candor is very important. So someone like Warren Buffett has a lot of candor in his letters. Like he's being very honest. He's telling you what he would like to know if he were in your shoes as a shareholder, if the roles were reversed. So that he's a very good CEO of being very straightforward. And what you see is what you get. He has integrity, and it shows because the share price has been going up for decades, right? So someone like Buffett, you can believe him, but there are maybe other CEOs and other letters that maybe they don't try to be as direct or as straightforward. And when they do that, if they're trying to hide something, they that might show up in the company. It might show up in the company culture and also how the company delivers results. And then if they do something bad, that can shake the shareholder confidence. Like, let's say, I'm not saying the CEO is bad at Credit Suisse, but let's
Yeah.
say that as an example of a stock that has been going down very quickly, right? And now UBS might buy Credit Suisse. Like in that example, I wonder what the communication from the CEO was like. If the CEO, instead of reassuring people, because people were worried a few months ago, like people have been worried about Credit Suisse. So no matter what the CEO did or said, the stock price just kept going down. So it would be interesting to compare, if we can go back, if that CEO ever wrote any letters, and see if there are any clues to how bad the conditions really were. So you could see, is the CEO making it seem like everything's fine, there's no problem? Because then if that wasn't true and you can pinpoint some of the cause of the company going downhill, then you can say, maybe they were not really wanting to acknowledge how bad things maybe really were. So I'm not saying anything, like I haven't read any literature that Credit Suisse has put out, but if you look at it like an investigation, like you put on like, you're gonna investigate the company and see where did things go wrong. Like it might not be the CEO's fault. There could have been other things that happened before, that were out of the CEO's control, or who knows. So it's not that person's fault necessarily, but you want to see, just as a clue, what was that important person's communication like, because they set the company culture, they set the tone. It's their job to lead the company. And if they're leading it, and like, if they're leading it and it's like, oh, you think everything's fine going up, but then it goes off the cliff, like, brr, like, then you're like, oh no, like, why did you thought you were going up, but then you just fall down. So it's confusing, right? Like why some CEOs don't want to tell people the truth. So, but then you see people realizing the truth because the share price is going down.
Yeah, the numbers don't lie, I think. Uh, I mean, they can lie for a bit, but then they show up.
Yeah,
Some,
so it's pretty wild. So Laura Rittenhouse taught me a lot about trying to read between the lines of, that's like an American idiom to say, like, read
hmm
between the lines of, you know, even if someone's telling you everything's fine, you have to look deeper and figure out, is it really, or is someone, another idiom is to say pulling your leg, which means to
Oh,
like, which means to kind of, they're, if someone's pulling your leg, it means they're not being honest with you or
honest.
something,
Yeah,
like
they're
they're,
cheating you.
yeah, a little bit, yeah.
Okay, okay, I see. Oh, that's so interesting. And I always like to hear about these stories because I don't last time I talked with this YouTuber and I interviewed him, one of his mentors is like Nassim Taleb. I don't know if
Oh
you
wow.
know. Yeah. And he actually had an interaction with him, but it was so unexpected because he actually got insulted by him because he was using a picture Nassim didn't like, and
Oh,
so I find like the interactions with your mentors are either like uh, better than your expectations, or it can be like something the other way around, and it's interesting to hear. And do you have any other story that you can share with us? With because I know that you've met a lot of interesting people in the Berkshire meeting and investors. Have you ever have the opportunity to see like any big CEO or something like that? Like I
oh
know,
sure, yeah. I mean,
yeah.
I met a few of them, like Jamie Dimon, the CEO
Oh,
of JP Morgan Chase. I took a picture with him, but I didn't really get to talk to him because he was just walking in the
yeah,
hotel lobby fast. And then I was like starstruck. I was surprised. And then someone said, oh, take a picture with him. And then I was like, okay. Like I was a little bit like, you know, a little bit like, oh my God, it's such a big deal person. But yeah, he
yeah.
was nice to take a picture with. And I met the CEO of Markel. Tom Gaynor,
Oh,
and he
yeah,
also
yeah.
has a very good track record in investing. And also, I met Mohnish Pabrai at the Berkshire Hathaway meeting on the meeting morning, and I asked him at the time. So many people were going up to him, and I
Mm-hmm.
said, "Oh, would you be open to a hot sauce challenge?" And he seemed open to it at the time. But then when I emailed follow up with him, and he had his assistant write back to me, the assistant said, "Oh, even though Monish, likes hot sauce and things like that, he says that you would win because I said I also really like hot sauce." So he didn't want to take me up on that challenge at that time. He said, in his, in life, he's not so, wanting to do too much hot sauce anymore. So
I
like,
guess.
yeah, he politely declined my challenge, but I also wanted to interview him, so maybe I'll try again at another time to say, oh, but even though we don't have to do the hot sauce challenge, but how about we just have a discussion about investing. And I actually added his daughter Monsoon Pabrai on
Uh-huh.
LinkedIn also, so she would also be good to follow her journey and see how is she growing as a professional investor. So that would be just kind of cool to like meet more people who are investing, and also younger people, like the next generation of investors.
Yeah, I have so I should have less expectations, but with Monsoon I have very high expectations because what what I've listened her say and her wisdom, like even though she's super young, she shared amazing insights in the investing with Tom podcast, and I think she will at least have a surprising record in investing, I guess. And it would be if you manage to meet her, let me know because I want to know what you discussed and how was it. I
Yeah.
guess like also Monish, he has like very high filters to um, like these kind of meetings and stuff. So I wish you a lot of persistence in that because I know you will make it, but I think you'll have to kind of think about a good way to convince him because from what I've investigated, he's like one of the kind of people like they have super high standards and filters like to
Mhm.
filter out the noise and like all the people that try to meet him. Like once I've heard him say in an interview, there are some people like trying to meet him from, let's say, people from Australia that go to Irving or something like that just to meet
Mhm.
him, and he declined. So uh, I guess like you must have a very good agenda with him or something because I know he mentioned that.
Yeah.
So but yeah, meeting investors and like-minded, because at the end of the day, we are all like kind of like-minded in some way because we are wired in a way that makes us like business and this kind of. It's also an intellectual challenge at some degree, and I think it also relates a lot to investigative journalism,
Mhm.
and I think like we all kind of share some interests, so it's always good to meet this kind of people.
Yeah.
And
And
I wanted to come. Sorry, go on.
I also want to say, when you mention investigative journalism, you might also want to talk with my podcast co-host, Sina Lonholt. So she used to do journalism before. So I think
Oh,
you would enjoy learning from her also.
I'm going to do that for sure.
Yeah,
Can you?
I can introduce you.
I add her on LinkedIn actually. I
Yeah.
think.
Okay, good.
Yeah,
Yeah,
yeah. I'll do that for sure, for sure.
good.
And she seemed like a very kind person too.
Yeah,
So
she really is. She's super nice.
and if she already passed your filter of high quality people, I trust you. So
Yeah.
for sure. One thing I listened in your interview at Millennial Investing was like, I think it was her that said this, that she has some kind of filters also to diversity in the management or in the board of the companies. Um, and I was wondering, like, if you have also this kind of more of an activist, or let's say, this kind of filters to your investing, um, just for curiosity.
Like seeing who is on the board of directors and things like that.
Yeah, or also things, let's say, for example, Coke. Coke, it's a great business. It's great culture and stuff. But at the end of the day, it's like sugar with water, and a lot of people are getting like uh, in really bad conditions because they drink too much Coke. Obviously, it's not full responsibility of who it's investing in this company, but is there any, like, let's say, barrier you find in this kind of field of more of an ethics point of view, let's say?
Yeah, I mean, I try not to invest in companies that I don't believe in. So, for example, I don't really drink soda, so it to me it's not interesting to invest in Coca-Cola. But it's not to say there's anything wrong with Coca-Cola per se, even though we do know a lot of people are becoming overweight and obese in America through a combination of factors. It's not just one thing. Like
Yeah.
it could be from a combination of sugary drinks and a bad food and not enough exercise. There could be so many reasons, but for me, it something like Coca-Cola is not interesting to me because I don't really use their product that much. I mean, I know they also have water products, but it's I haven't studied the beverage industry to decide if that's of interest to me, or it also is not a very fast growing company anymore. So sometimes the best you can get out of something like that is just dividends. So if people like dividends, maybe they might like Coca-Cola because people will continue to be thirsty, right? People will always be thirsty. You can never get rid of that biological need, but at the same time, it's to me, it's that kind of company is not so much about ethics, but just of of if it's interesting to me and if I like the products and services. But in this case, it's not that. But other companies that I try not to invest in are like vice companies that
Mm.
if some companies are making smoking products, I don't believe in smoking, so I don't invest in companies like that. And that's more of an ethical reason. even if
Yeah.
even if they're very profitable, they might be very profitable, but then they could also be really bad for people, right? So I don't want to go in that direction either.
Yeah, and you can also see that as a fragility, let's say, because it might be going very well right now, but we can never predict if some regulation will kind of cut their business, or yeah. So I
Yeah, and
think
also, yeah,
that's,
like one example of that, exactly like you said, is in New Zealand. They banned the purchase of cigarettes for people born in 2008 and after.
oh, yeah. So yeah,
So,
yeah, so that's an example.
yeah, exactly. So in the future, that some of those companies might lose business in New Zealand.
Yeah, so I really believe in what you said. Like, also, it gives you kind of an edge over other people. For example, I know. Could you repeat the name of your friend because it didn't stick with me?
Oh, Sina Lonholt?
Sina. Okay, Sina. Yeah, Sina. I heard she worked at Lego.
Yeah,
Yeah, I don't know if she invests in it, or, but
it's
I'm pretty
I
sure.
think a private company.
Ah, yeah. So I'm sure that if she was to invest in Lego, if it was public, obviously, she would have a massive edge on other people, because it's not only a company from Denmark, but maybe also something she's more knowledgeable. Yeah. So basically, it's very good to invest in what you already know and products you use, and for example, in this case that we were just talking about, companies that you work at. So for you it was Starbucks. For Sina it's not a Lego because it's not public, but if it were to be, it would be a great edge over other people, because you it's like you really get to know the culture, and it's something that really gives you that little advantage over other people.
Yeah, especially if, let's say, a publicly traded company gives you the option to invest in the shares. And some companies, they call it something like employee stock purchase program. And then they
Mhm.
might even give you a little bit of a discount, like 10 or 15% from the current share price. And then they might buy it for you once a quarter if you contribute to a little fund that will then be like, okay, you put in some money in there and then we will buy shares for you. So if they have a program like that, it can be very nice because then you can get even more of a discount on a good company if you believe in it. Like it's it's only it only works if you buy it in a company that you believe in. Like if you don't like the company you're working for, then maybe you don't want to buy their stock.
Yeah, that's true, and it also comes to the a really big advice or ethos of Charlie Munger of buying good quality companies, because like good quality companies, good quality people, and good quality work give you less problems over time. So maybe in the short term, it's easier to just do the easier stuff, or really find the no-brainer bargains, let's say trading below half of book value or something like that. But if it's trading at those kind of multiples, it's for some reason. And nowadays, I feel like with all these uh, information, and it's very very hard to find something that it's trading at such a discount in an obvious kind of way. I think, as you mentioned before, it's not that black and white nowadays. So yeah, those kind of opportunities uh, also can show up from time to time, but are very rare. And I think having a little bit of skepticism around those things, it's valuable. And I don't know if you agree.
Yeah, it's important to always be critically thinking because that's one benefit you might gain if you go to higher levels of education like university is sometimes one of the most important lessons you can take from that is the ability to independently think. So if you can learn skills of critically assessing what you're reading, and then you can write like an like say an essay of explaining the rationale of how something happened. Those are very good skills to help you, like we talked about, investigative journalism, to understand what's happening at a company and to try to clearly write down the facts and what evidence supports what do you think is happening there, like what do you think is the real truth, whether you work at the company or you're on the outside, either or it can help to really carefully think and think on your own. Like even if
Right.
some people are telling you something, you have to decide for yourself, do I believe it? Is it true? Like you have to reach your own conclusion and not just trust people too easily. Like you have to really um try to I think that's one of the important lessons also is no matter what anyone on Wall Street says, like analysts, that's also why Warren Buffett didn't want to be in New York City because he wants to be able to think by himself and think, what do I really believe? And it helps if you have that physical distance between, sort of the herd mentality of what everybody else thinks. And then if you are separate from that, then you can think more by yourself and come to your own conclusion.
Yeah, that's so true. And I think one very very important skill that not everyone talks about in the investing world, but Warren and Charlie mentioned it as being essential for critical thinking and independent thinking, is the broad topic of emotional stability. Because as you said, going against the tide and being an independent thinker many times means that everyone else will disagree with what you're executing on or your bet or whatever it is that you're doing. So it's something really I've been trying to investigate a little bit more, because I see this investing journey more as like a self-improvement journey. And I think emotional stability, it's a big thing in investing. So I was wondering, what's your take on it, first of all?
Yeah, I mean it's something that you gain experience with over time. So, for example, it's great to start learning how to invest and doing some investing the younger you are, because then you can build up experience of how you feel. Like I made a video about some of my top 10 mistakes in investing before and talked about what I did wrong. And some of those are like, if I say invested in a company that I didn't really understand, and I was in it for the wrong reasons, or maybe the story changed and then I come to regret that I was in it. So let's say, for example, one time I just bought a company for the dividends, but then the company wasn't really going anywhere, and then I realized, like, oh, I shouldn't have done that. So I felt like, I realized that I shouldn't only be investing in a company just to get some dividends, because actually that's not a very good allocation strategy. So I felt bad because I was like, oh, I wasted my time and my money and it didn't go anywhere. Like, I got a little bit of dividends, but basically I didn't have much of a return. And that was over, let's say, some years. And then I said, oh, I could have been investing that money somewhere else. So it's, I wanted to kick myself for, the money not being exercised in a better way, of it's not working that much better. So I realized that company was a mistake. Or also, I was invested in a company that right in the beginning of the pandemic in March 2020, it went from like a normal price down by 60%. And I was like, oh man, like that is a big drop, and it felt a little bit like, oh, did I make a mistake? But now I'm stuck. So even though, you see it and it's like minus 60%, but you can't let that make you feel bad and then panic sell. So I decided, even though it's down so much, I'm not going to sell. I'm not going to give in to what a lot of people would do with panicking and say, a lot of people at that point are like, oh, like let's say they invested $10 and it's down 60%. Now it's worth $4. They might be like, I want to get my last $4 out. At least I can get something out of nothing, because in their mind, they already decided it's already lost. I already lost all that money. But you have to stop yourself. If you feel that way, even if your investment is down 60%, you have to be like, wait, I had an investment case for this purpose. Like, there was a reason why I think this company is worth more. So what I decided is, even though it looks ugly, even though on the surface it looks like I lost a lot of money, but you have to think more rationally and not feel emotional. Even though it's hard to not feel emotional at first, but then, take some time, sleep on it, go back to it in a few days, and think about the investment case. So think about the facts, not how your emotions are, but the reason why you invested in the first place. And then I decided, okay, even though this looks bad, however long it takes for the investment to come back, whether it's a few years, I will be willing to hold on to it until I get my money back. So fortunately, it worked out that within about, like a few months, it came back to where it was before. So it wasn't so bad. But in that case, I got a little bit lucky, because if it had been negative for a long time, that could wear on your emotional resolve. But I just got lucky that it came back sooner. So then I was able to sell out of it at a small profit. But at the time, that was a pretty, strong emotional hit of like, oh no, I'm stuck in this investment and I could lose money if I sell. But you just have to remember to not sell, to remember, um, that hopefully you had a reason to invest, because a lot of people just put money in companies, but they're not really investing. They're more like trading. And then if they didn't really study the company, they freak out, and since they didn't do the work to understand the company, they don't really know what the company is worth. So then that's why they might panic sell, because they're only seeing the numbers on the screen when they came in at one price, but now they're like, oh, I lost money. So then since they don't know, they can only go with one factor of the price, and that's a bad situation to be in. You don't want to have put money in something that you don't know anything about. So that's why a lot of people just panic sell, because they have no idea what their money is really in.
Mm-hmm. I have a couple of follow-up questions to this because it's such an interesting topic for me. And I would like first to go like to what would have needed like what needed to happen for you to actually buy in more at that, like let's say 60% drop, for example. I know Bill Miller or some of some kind of very like super investor actually made an investment, and like the day after it drops like 60% or something like that, and he just doubled down. So why did you not, let's say, do that at the time? And what would have needed to happen for you to do that? Let's say.
Well, at the time, I was actually really scared about it, like that I made that mistake, and I didn't want to invest more in that company actually, because I had wanted to get out of it before.
I
So to
see.
me, I was not so incentivized. Maybe I could have bought more, but I was no longer interested in that company. But the other companies that may have been on sale in March 2020, I thought at the time a lot of those were down maybe 35% based on the overall market. But I thought, for me, I was like, this is not enough of a discount. I want those companies to go down to 50%. So some really good companies, like better quality companies than the one I was in, unfortunately, they did not go down even more. And that was also a mistake. So in my mind, I decided I was trying to save cash for other investments, but then I
Mm-hmm.
did not jump in. So that was called an error of omission, because I could have invested even at a 35% discount, but then I decided it's not enough of a discount. So I made that mistake. So sometimes it's, maybe that was also an emotional mistake, because I I had in my mind, I only want to buy if it's 50% off, not at only 35% off. Like, I decided it wasn't good enough for me, but it was good enough for a lot of other people. So then that's also another mistake, is if you have an idea and you think that your idea is more correct or more right, but then you can make a mistake by then missing out. And then I missed out on other investment opportunities that, from that time, they might have gone down 35% at that time, but then they doubled. So then I made that mistake because I had some other expectation of what the market should do, but then the market didn't do what I wanted. So I would have I would have wanted to buy more. That's a good idea to, if you're in a good company, you should buy more when it's going more on sale. But I was thinking that this was the beginning of the next big recession, or the next big, like what we had in the great financial crisis of 2007 to 2009. I
Right.
thought it was just the beginning. So I didn't want to jump in too early, and then it would go down another, a lot more after that. So it happened so fast, and then the, American economy got bailed out so quickly. So I wasn't expecting that. So I was
Yeah.
wrong on basing some of my investing decisions on what happened in the past. Like,
Mm-hmm.
I could not have predicted that the stock market would just skyrocket after the government said we're going to do a lot of money printing and help people. Like, I had no idea. And then that caused inflation and caused the stock market to still be inflated. But now that's why I think the stock market is just going sideways, because it's it got built up so much, but there's not enough fear to make it go back down again. So
Yeah.
even though I secretly or not so secretly hope for the market to go down again so I can actually buy things on sale, maybe it will never go down enough again. And now everything is permanently at a higher level. And I might have to live with that, you know, even though I didn't get as good of a discount then, maybe it's okay if sometimes I don't get enough of the discount I want. It's sometimes a little bit is all that we can settle for maybe. So yeah,
Right.
it's like a weird it's hard to make that judgment call because even though you have an investment case that you want to happen, but it
Hmm.
doesn't always get to there. You might have done valuation calculations on a company and that say, okay, if you want a 50% margin of safety, you have to buy it at X. But what if it never comes to X? So are you supposed to not invest? So that was one of the bigger mistakes I made since
Yeah.
2017 is I've been purposely staying out of some companies, but that's the same mistake that even Phil Town made. So he's been also making some of that same mistake since 2017. And one of his friends told him, you know, he said to him, "Oh, you said to be in a lot more cash, but I'm glad I didn't listen to you, Phil Town, because if then I wouldn't have invested." And then so basically, it's kind of funny that both I made the same mistake as Phil Town did by being a
Yeah.
little bit too conservative and holding on to too much cash in the last 5 or 6 years.
Right. Yeah, I guess like you knowledge always compounds. So you lose in, let's say you lose in a way because you made a mistake of omission, but at the same time, this is the time to make mistakes and not when you like I read this paper from talking about Nassim Taleb and his mentor was like a trader or something, and he really made a big mistake when he was already at the top, and then he lost everything. So it's better to like uh, not lose and not win, but at least recognize the mistake that you made and maybe use it and leverage it in the future. So yeah, that's a great point, and I think I also wanted to praise you because not everybody likes to talk about their mistakes. I'm sure no one likes to like talk about the mistakes, but if you really want to be a successful investor or at least live life in a way that you don't lie to yourself, rubbing your nose in your mistakes, like Charlie Munger says, it's like the only way to go. So it's really courageous of you to share your mistakes, and I'm sure it brings a lot of value to me for sure, but to the listeners too, to listen to your experience. So yeah.
Yeah. And also the one thing I wanted to add about that was in speaking of rubbing your nose in your own mistakes, is like if you do it enough, you make enough mistakes, and let's say your investment is down 50 or 60%, then you're just I'm just going to live with it. You just decide, okay, that sucks. It's not great that it's down so much, but I'm not going to lose my money. I believe in the investment case and I believe that it will come back. So you have to you have to resolve in yourself that no matter what, you're not going to just sell randomly out of panic or boredom, but you're going to stick with it. So what I've learned is even though some of my friends will joke like, "Oh, I wish I wasn't down so much in this stock," right? But then I just put it out of my mind. I just don't focus on it. Like I just, I know it's happening. I know it's down a lot, but I just focus my time and energy on something else because that's another thing that we learn with maturity is you can only control what you can control, right? So I cannot control these multi-billion-dollar companies. It's totally out of my control. I made an investment case and maybe I invested at the wrong time at too high of a price, but I believe it will come back. So if you have that conviction and that fortitude, the inside, this is what you need to live by. You don't live by like oh no it's down on the surface it's not great, it's not a nice feeling, but you just have to not focus on it because that's when people make more mistakes if they get too nervous or they get they feel so bad that they want to take an action, but then you're just digging yourself more in the hole if you make an action like that. So you have to just try to stay rational and just try to focus on something else that you can control in your life. And then hopefully, hopefully it will come back if you already made that mistake. But to me, there's no point in selling something that's already down 50% unless it's going to go down 99%. Like let's say Credit Suisse again. Like if you
Yeah.
bought that in 2007, like maybe you have to cut your losses. I was looking back on that stock just out of curiosity, and it's amazing how it went from $70 a share in 2007 to now like less than $1 in recent days.
Yeah.
So something
That's
like that.
that's
If it's
crazy.
if it's a really bad mistake like that, that's different. That's, to my mind, about to go bankrupt. But as long as the company that you're invested in is not about to go bankrupt, like it still has a good possibility to recover and do well in the future, then it's okay to stay in it. But you have to, I've never invested in a company that was about to go bankrupt. So I'm, I don't know if Credit Suisse will go bankrupt, but everybody is treating it like it will. So that one you have to realize ahead of time. Like if you invest at $70 and now it's at $35, even if you have to, live with that loss, at least getting out at $35 is better than getting out at 90 cents, where like that,
Right.
yeah, like this, that would be, really sad if you waited that long to get out. So at that point, your entire investment is gone. So, you have to try to make as best of a judgment as you can, given the facts of what's going on with the company.
Right. And I think also it's very useful to ask yourself, why is this down? If, for example, it's a macro trend, or um, let's say something that's not that likely to really happen, or from what you can like investigate yourself, it's not something that really interferes with the value of the company, then maybe it's a good time to really understand if it's good to put more money in,
Yeah.
or just do nothing. And yeah, so
Yeah, you have to decide, have the fundamentals of the business been really affected? Like at the end of the day, the economics,
yeah,
can they still make money in the way they usually do business? Or is the way that they usually do business going to be changed forever? So that's a question, like, for example, a lot of people are asking of Google and Alphabet, of is their business model going to be threatened by Chat GPT? So something like that, you have to, think, has the business moat been attacked by something that's even better and stronger than what it
yeah,
used to be?
yeah. And actually, talking about ChatGPT, I would like to talk to you about this at the end. But first, I have one last question. And you mentioned like um, it's very important to have an investment case for maintaining emotional stability in investing, because you can really look what was your reasoning back when you made the investment. And for example, Jake Taylor, which is an investor that I like a lot. I don't know if you know him.
Yeah, I have his
Yeah.
book.
Ah, nice. And I was looking for it online, but I couldn't find it. So I think I'll try to order it on Amazon, I think. But yeah, anyways, he built this software business called Journalytic, that's really useful to, it's like a journal for investing basically.
Mhm.
So what, in practical terms, what do you do, let's say, to store your investing ideas? Or do you write in paper? Do you have a like Evernote or something like that? Where do you write your thesis to really help you out in those moments that you maybe struggling with some downturn in the market, or really understand uh, if your reasoning was accurate, let's say?
Well, some of that I put in. Excel sheets, like when I'm doing valuation calculations, and I put like the bullet points of the investment case of what the company is about. And like I source that from like some of the 10K or other reports about it. And I have folders where I save a lot of articles and
Hmm.
literary evidence of what the company is doing. And so, in a combination of like doing valuation calculations and having a folder, and also like some text document, like say Google Docs, you can put your explanation of like why am I in this company, and it's just for myself. Like I'm not sharing it with other people, but I just write down, some of the um, explanation of the investment case for, and also the investment case against.
Hmm.
It's important to also have the reason why you shouldn't invest in the company, so that you can mentally prepare if the story changes, and if the moat is no longer as strong in the investment case for it, then there might be other reasons why um, other entities might attack that company. And so that might give you reasons, like if enough of those possible problems come true, then it helps you be prepared in case you have to sell in the future.
Right. Yeah, that's nice. That's nice. And have you ever thought about using his software?
No, I
Like
haven't, but I mean, I think you just have to use what works for you. So
works. Yeah.
yeah, I like just using, normal stuff that I don't have to pay for, just because
Yeah, yeah.
I'm still an amateur investor. So I'm not so fancy that I need extra things. I can be okay with basic tools.
Yeah, I think that really keeping it simple is the only way to go, because otherwise you'll try to optimize on all these little things that really at the end of the day don't move the needle. And so it's, yeah, I think your approach is what I would like to do myself.
Yeah, just
Um,
just save it somewhere that you know you can come back to.
yeah,
Whether it's in a paper journal or in an online mechanism, whatever it is, as long as you can save it, and you can come back to it in the future, and you will not lose it or something, or
mhm.
like some people losing their Bitcoin keys or something. Like you don't leave that somewhere that 10 years from now you don't know how to find it or something like that.
Yeah, yeah. That's good advice for you, for the Bitcoin investors. Yeah, I think to wrap this up, I will leave the ChatGPT for another day, because
Yeah.
it's not really our let's say circle of competence. But the last question I wanted to ask you is, I don't know what's your situation right now, if you're doing I'm pretty sure you're doing investing like part-time, or just yeah, as a like passion. But would you ever consider, or do you have aspirations to become a professional investor, or have your own partnership slash fund or whatever?
Yeah, I think it would be really cool to be able to do something like that someday. Like I want to prove to myself that I can be a good investor. So I think it just takes time, but I think it would be fun to maybe do it professionally someday. So even though I'm not trying to um, get to it too quickly, I'm just taking my time, and I just want to prove that I can do this. So I feel like I have not yet quite lived up to my own expectations yet for being as good of an investor to myself. Like I've done
Mhm.
okay, but I feel like I could do better. So I think I still need to work toward that direction. But I think it would be a great aspiration. Like I would be happy to either, if not a fund or be a professional investor with a partnership, maybe just run a company, like be at a higher levels of operating and running a business. I think that's also a very good way to
Yeah.
practice capital allocation like an investor. But sometimes it's nice to also be the leader in a company or business, because like how Buffett is doing, he's both the leader of a business and also the investor. So in many ways they're very similar.
Or
Whereas like
Tom Gainer.
yeah, exactly. Whereas like some other company CEOs, they're just salespeople. So I don't want to just be a salesperson who's really good at talking up the company. I also want to make good allocation decisions. So we all just like gain that with time. Like the more we experience or we get to work in somewhere that teaches us these lessons, like even though I didn't appreciate this at the time, but I keep going back to Starbucks. I learned important principles about cash handling and managing inventory and cleaning up the store and how you organize all the people and the store and when to give people breaks. Like even though I learned those lessons when I was younger, those are good lessons to learn about how you manage and operate even a store and how you deal with people and money and making sure you have enough supplies and that people who are working are happy and they get their lunch break or whatever. All of managing a lot of those things teaches you a lot of skills. So I think it's good to learn practical skills of running a business. So whatever you can do to learn how to run a business, I think that's an important skill for investing.
Right. That's some great aspirations, and I really think we are aligned in that sense because I think it's even a better structure what Warren has as compared to, let's say, an investing fund, because sometimes investment funds are really have some pressure to act, and that's not really what you want to do, if at least if you want to achieve higher than average returns. So I think that's a good way to frame it. So yeah, I think we can wrap this up here. And just thank you a lot for all the time you give to these conversations. And it's such a pleasure to be talking to people like you. And yeah, thank you so much.
Thank you, David. It was wonderful speaking with you as well. And I'm always happy to try to be as helpful as I can because you're part of the next generation of investors. And the more that I can help you, you might help other people. And also, you help me because your questions help me consider my investing approach and where my career is going. And so you are helping me also a lot. So thank you so much for all that you do. And your curiosity. I think it's wonderful, and you will go very far because you're curious and determined, and you also are persistent. So it's great. Like I think as long as we keep up those things and hold each other up, I think we'll go very far in life.
That's great. That's great. Thank you so much, and we'll see each other next time.
All right. Take care, David. Have a good rest of
Take
your day.
care. Bye bye.